Let's talk about whole life insurance. A lot of people have asked me over the years, I've heard so much about whole life insurance. Should I be investing in whole life insurance? And I've come across a lot of people where their entire plan is just sucking money into whole life insurance and doing nothing else. And it seems that a lot of people kind of fall into that trap where they have this one strategy and it's a one-size-fits-all. This whole life policy is going to pay for my kids' education, my retirement, my emergency fund, and every other need that I may have. Well, we believe that that's a severe lack of diversification. You may be a candidate for whole life insurance if several unlikely criteria fit, and I just want to go through some of those. First of all, you need to understand that most whole life insurance is very illiquid. Usually the first couple of years, a very small percentage of the amount you put into it is available for you to pull back out. Now there is an exception to that, and that is you may be able to get what's called a high early springing cash value policy, where about 80% of what you put in is immediately available. So those are out there. If you are interested in whole life and you need more liquidity, look for a high early springing cash value whole life policy. The other thing that you need to have as a requirement if you're going to invest in whole life insurance is you need to make sure you've got a very long time horizon. When we think long time horizon in investing, we might be thinking 5 or 10 years that we hold an investment. Really, with whole life insurance, you need to be looking at least 20 years. Because at year 10, you're just talking about a break even. Maybe a slight loss, maybe a slight 1% annualized profit if the thing does very, very well. So 10-year time horizon, whole life insurance isn't for you. If you're looking at a 20-year time horizon and you're very conservative and you need the coverage, certainly don't buy life insurance if you don't need the coverage. Okay, there's no life insurance that makes sense if you don't need the insurance. But if you have whole life insurance and you need the coverage and you don't need liquidity, and you've got a 20-year time horizon, you're looking at a probably 3 to 5% return. Over the last 20 years, for most companies, it's been a 3-4% return range. A few companies out there have been able to deliver 4-4.5%. Most of them illustrated 5-6-7% returns when they said what the policy, what they thought it was going to do, and it turned out that those illustrations overshot what they anticipated. If you go back 30 years, the inverse is actually true. They estimated 5-6% returns, and they may have delivered 6 or 7 in some cases. And the reason for that is you'll remember the 1980s, we had very high interest rates. Well, the inverse is true today. And so buying whole life insurance in terms of risk is not a static matter. Risk changes with what type of investment we're buying based upon the environment. Typically, the returns, the dividends that are paid out of a whole life policy are derived and lag the 10-year treasury, which we know is at an all-time low right now and is likely to stay low for the next several years. So if you're looking at the next 10 or 15 years whole life policy returns, I would anticipate they're going to be lower than they have been in the past, which they already have been low. If you're looking at 20, 30 years, it's hard to say, but certainly the interest rates are likely to go up, meaning dividends will probably go up back to where they were maybe 15, 20 years ago in whole life insurance. So as we look at returns over 25, 30 years, plan on probably 4 to 5% returns in your whole life policies. Now, everybody has different opinions on this, but 4 to 5% may not be if you don't need liquidity. If you really plan on keeping that investment for 25 years, a 4 or 5% net of all fees, net of all taxes type of return may be very respectable. In fact, the reality is someone that bought life insurance, a whole life policy 30 years ago, is probably far better off than the average equity investor who, according to the statistics, made a 2.5% dismal return in the last 20 years and who paid taxes on that 2.5% return that they made along the way. So certainly as you compare that to somebody who just put money into a whole life policy and forgot about it, they outperformed them. And that's the reality. Even though there are a lot of people that say absolutely stay away from whole life, well, anyone who invested in whole life insurance 25 years ago, believe it or not, probably outperformed their equity counterpart based upon what the statistics tell us. Now, I believe that a diversified, disciplined investor can outperform and can do more in lines with what the equity markets return. So in the same period of time that the equity markets returned 8-9%, the average investor made 2.5%, because of really poor emotional decisions. Nonetheless, as you look at whole life insurance as an investment, make sure that before you buy it, you're going with a high quality company, because you're going to own this 20 or 30 years or until you die. Make sure that you have one where the provision to borrow cash out of it has a low or a zero cost associated with it. So you're not borrowing money in 20 or 30 years in retirement and paying interest forever on that money to the bank. And finally, make sure that you have something else in your portfolio that can offset inflation. Okay? Whole life insurance is not an inflation hedge. One of the risks that you're going to face over 20 or 30 years is that inflation. And so you need to make sure that some part of your portfolio has a hedge designed to grow at a stock market or real estate market like returns, where the whole life insurance, if you need those guarantees and you want that level of safety, becomes only one part of your portfolio, the defensive part of your portfolio.